If you think $200 oil is just an energy story, you are already late. It is not an energy story. It is a pressure story, a rate story, a margin story, a liquidity story, a forced selling story. And if you still do not understand why gold can fall while the world gets more dangerous, then you are standing in front of the wrong scoreboard. That is where I want to begin. Because most people are about to misread this entire episode in the most expensive way possible. They will watch the Middle East burn, see oil spike, hear the words inflation and safe haven, and assume the script is simple: oil up, gold up, stocks down, wait for clarity. That script is too childish for the market we are in now. The market we are in now is more violent than that. It is more connected than that. And the people who understand the chain reaction before the public does are going to live through a very different next 12 months than the people who keep staring at headlines and hoping the old textbook will rescue them. If you want the mother line for everything I am about to tell you, here it is. The real danger of $200 oil is not the number itself. The real danger is that an oil shock at this stage of the cycle turns inflation back up, traps the Federal Reserve, strengthens the dollar, pressures leverage, forces liquidation in the wrong places, and then reassigns wealth toward the assets and businesses built to survive a world where energy, capital, and timing all become much more expensive at once. That is the line. Read it again, because once you understand that, you stop asking the wrong question. You stop asking, will oil hit exactly $200? You start asking, what begins to break if the market gets close enough to believe it could? That is the better question. That is the more profitable question. That is the only serious question. Most people never learn to think this way because they were trained to read each market one at a time. They look at oil as oil, gold as gold, the Fed as the Fed, stocks as stocks, the dollar as the dollar. That is amateur thinking. The market never punishes one thing cleanly. It punishes a chain. Oil does not only touch gas stations, it touches freight, food, fertilizer, airlines, input costs, consumer confidence, inflation expectations, rate expectations, bond yields, valuation multiples, currency demand, and if the oil shock is large enough, it also touches something else people hate admitting. It touches psychology. A late cycle market can handle a lot of bad news, as long as the bad news stays compartmentalized. An oil shock of this sort is dangerous precisely because it refuses to stay in one box. It leaks into all the others. That is why I am speaking plainly, because when markets move from separate problems to one integrated pressure system, the public is usually late by the time it notices the difference. Now let me show you the first mechanism. I call it the choke point tax. The choke point tax is what happens when a narrow physical route on the map becomes a sudden global cost increase even before the route is fully closed. That is what the Strait of Hormuz really is. Not just geography, a tax collector, a toll gate, a pressure valve, a place where fear can begin doing economic damage before the first full shutdown ever arrives. That matters more than people think. The public keeps imagining a clean binary event. Either the strait is open or it is closed. Wrong. Markets do not need closure. They only need credible danger. The shipping companies do not need certainty of destruction. They need enough uncertainty that the economics stop making sense. The insurers do not need 100 sunken tankers. They need enough threat that premiums explode or coverage gets pulled. The traders do not need missing barrels. They need the possibility of missing barrels. That is the choke point tax. And because around a fifth of global seaborne oil passes through that route, the tax gets large very quickly. The source material centers the Strait of Hormuz, notes about 20 million barrels a day moving through it, and argues that insurers and shippers can choke the economics long before formal closure occurs. This is why the market never waits for final confirmation. By the time final confirmation arrives, the better part of the repricing is often already done. The market prices probabilities. The average person waits for proof. That difference is where money changes hands. If a tanker route becomes dangerous enough that premiums spike, schedules slip, and traders begin bidding defensively, then oil does not need to stop moving to become more expensive. It only needs to become less comfortable to move. That is enough to change calculations, enough to change hedging behavior, enough to change who begins hoarding, who begins rerouting, who begins panic buying, and who begins realizing that an energy system running close to capacity does not absorb fear gracefully. That is the first mechanism. The choke point itself becomes a tax on the whole world, not because a government voted it in, because risk did. Now, let me sharpen the point. A lot of people still think the real question is military. Can the Navy escort tankers? Can the route be defended? Fine, that matters. The market cares about a colder question. Can the route remain economically normal? That is more important. If the answer is no, then the world begins paying before the world begins understanding. That is the choke point tax. Now let me take you into the second mechanism. I call it the oil ladder. This is where the shock climbs out of the shipping lane and into every room of your life. The oil ladder is the sequence by which a higher crude price moves upward through transport, industry, food, retail margins, consumer expectations, and finally into the central bank as prison. That is the ladder. Most people hear oil up and think gas station pain. Too small. Gasoline is only the most visible expression. Oil is freight. It is trucking. It is shipping. It is jet fuel. It is plastics. It is industrial inputs. It is fertilizer. It is refrigeration. It is pieces of health care. It is packaging. It is everything that must move, preserve, wrap, heat, cool, or manufacture the things ordinary people need. That is why an oil shock behaves differently from a random commodity spike. Oil does not stay where it began. It climbs. That is why I call it a ladder. One rung becomes another. A higher energy input cost becomes a higher transport cost. A higher transport cost becomes a higher shelf cost. A higher shelf cost becomes weaker household flexibility. Weaker household flexibility becomes weaker demand somewhere else. Weak demand meets high cost, margins compress. And then the market begins to discover the ugliest feature of all. This is not just inflation, it is bad inflation. Inflation that arrives without strong growth. Inflation that tightens one side of the economy while suffocating the other. That is what the source material is really trying to explain when it says oil is embedded in everything, from transportation to food to pharmaceuticals, and that a move toward $200 would likely push inflation far beyond the Fed's comfort zone. That matters, because clean inflation and dirty inflation are not the same thing. Clean inflation can sometimes be managed through confidence, rate policy, and resilient demand. Dirty inflation arrives with stress, with war, with constraint, with pressure, and dirty inflation is exactly what traps a central bank. That is the next rung on the ladder. Now let me say something harder. When oil climbs this way, it does not only attack the consumer, it attacks capital structure. It attacks the very assumptions embedded in valuation models, because once inflation reaccelerates, the whole market has to ask a much harsher question. If the Fed cannot cut, then what exactly was supporting all those rich multiples and all that cheap optimism in the first place? That is the question investors do not like to ask. They prefer cleaner stories. The oil ladder does not allow clean stories. It keeps carrying the problem upward until the whole system is dealing with it. Now let me take you into the third mechanism. I call it the Fed trap. This is where the story stops being about crude and starts becoming about the entire pricing architecture of modern finance. The Fed trap is what happens when inflation pressure rises enough that rate cuts become politically and institutionally dangerous, while the broader economy is already fragile enough that holding rates high keeps grinding growth and hiking further risks detonating whatever remains most overleveraged. That is the trap. And once you are in it, every decision becomes a confession hold. You admit inflation is too alive to ease cleanly cut. You admit the system is too weak to survive honest restraint. Hike, you admit you are willing to hurt housing, banks, risk assets, and debt. Heavy balance sheets even more in exchange for trying to reclaim credibility. Those are not clean options. They are damaged choices. That is the Fed trap. The source material makes this clear in its own way, arguing that hot inflation and an oil shock could leave the Fed holding all year, with some market participants even expecting no cuts and potentially higher rates later if inflation reaccelerates hard enough. Now, let me make the pressure explicit. For the last several years, the entire optimistic case for risk assets has leaned heavily on one comforting assumption. If growth slows enough, the Fed will cut. If things get ugly enough, the Fed will relieve pressure. If rates stay high for too long, policy will bend. That is the old comfort. But what if oil moves high enough that inflation starts forcing the Fed to watch prices more than it watches equity markets? What if the market begins to understand that the Fed is no longer choosing the ideal path, but only rationing which group gets hurt first? That changes everything. Because once the central bank moves from rescuer to allocator of pain, assets priced on the old rescue story begin living in a new world. A world where the discount rate stays rude, a world where the debt burden stays heavy, a world where long duration stories get repriced, a world where people discover that higher for longer was not just a slogan, it was a lifestyle shift for capital. That is the Fed trap. And I want to say something very plain. A lot of people hear that rates may stay high and still think in the old terms. They think, fine, maybe one or two cuts are delayed. That is still too polite. The real issue is not whether rates are a little lower or a little higher than last quarter. The real issue is whether the price of money stays high enough long enough to rewrite the economics of entire sectors. That is the harsh question, and that is why the next mechanism matters so much. Now, let me take you into the fourth mechanism. I call it the dollar hammer. This is where people get emotionally confused because they think danger should automatically mean gold up and dollar down. Sometimes not in a forced liquidity phase. The dollar hammer is what happens when inflation stress, higher rate expectations, and global fear all combine to make the dollar stronger in the short run, even while the longer run monetary picture may still be rotting underneath it. That is why markets are so cruel to people who rely on slogans. The slogan says crisis means gold up. Reality says crisis plus forced liquidation plus higher rate expectations plus a stronger dollar can mean gold down first. That is the hammer. And if you do not understand it, you panic exactly when you should be classifying. The source material explains this chain directly. Higher oil feeds inflation. Inflation keeps the Fed from cutting. The resulting rate outlook supports a stronger dollar, and a stronger dollar becomes a headwind for gold, especially for international buyers. That is not irrational. It is just sequence. A stronger dollar does not mean the system is healthy. It means the system is demanding dollars harder in the short term. Those are not the same thing. Now, let me make the distinction clearer. The dollar can strengthen as a pressure valve while the long-run purchasing. Power story is still ugly. The market can still seek dollar liquidity in the short term, even while the debt, inflation, and monetary architecture all remain suspect in the long term. That is one reason crises are so good at humiliating people who want one clean narrative. There is in T1. There are phases. Short-term liquidations can strengthen the very thing that long-term debasement later weakens. That is not contradiction. That is the sequence of pain. And if you understand sequence, you stop getting tricked by headlines that sound paradoxical. Now let me take you into the fifth mechanism. I call it the gold flush. This is where most retail investors lose the plot entirely. The gold flush is what happens when gold drops in the middle of a global shock. Not because the long-run case for monetary protection died, but because gold has become a source of immediate liquidity for governments, funds, and leveraged investors who suddenly need cash more than they need conviction. That is the flush. The source material makes several versions of that case. It points to Gulf sovereign holders selling, mentions panic gold selling elsewhere, describes ETF outflows and forced selling, and explains how leveraged paper gold products can create margin calls that accelerate the move downward. Good. That is exactly the right direction, because gold is not only an inflation hedge, it is also a liquid asset. And liquid assets get sold in stress for one brutal reason: they can be sold. That distinction matters. A person under stress does not always sell what he least likes. He sells what can clear. A fund getting margined does not write a love letter to monetary history. It meets the call. That is why gold can fall violently in the early or middle phase of a crisis. Not because the thesis is dead, because liquidity demand temporarily outruns conviction. This is also why I have always told people to separate paper movement from deeper structural meaning. A price move is information. It is not always a verdict. The public sees gold falling during a war and concludes the safe haven idea must have been foolish. That is shallow thinking. The real question is, who is selling and why? If the answer is leveraged holders, forced liquidators, state-linked sellers under pressure, or ETF outflows triggered by the short-term dollar move, then the fall may be far more about the plumbing of stress than the death of the monetary thesis itself. That is the gold flush. And once you understand that, you stop treating every violent move as philosophical revelation. You start treating it as positioning data. That is a much colder and much richer way to think. Now let me sharpen it further. Silver often behaves even more violently because it is both a monetary metal and an industrial one. That means it gets hit by liquidation, dollar strength, and industrial growth. Fears at the same time the source material notes that physical and paper markets can diverge, and that silver's industrial pull can make its behavior sharper than gold's cess. Exactly. Violence does not automatically mean brokenness. It often means compression, and compression is where the next move begins, storing energy. Now let me take you into the sixth mechanism. I call it the equity repricing chain. This is where oil becomes not just a macro problem, but a direct attack on the assumptions holding up your stock portfolio. The equity repricing chain is the process by which higher oil feeds inflation. Inflation keeps rates elevated, higher rates raise financing costs, and higher financing costs compress profits and lower valuation multiples, especially in sectors dependent on cheap capital, stable demand, or both. That is the chain. And once it starts moving, you cannot just say, stocks down, as though the damage were evenly distributed. It is not. The source material points toward several sectors, and does so for a reason. Airlines and some consumer names get hurt by fuel and margin pressure, banks and rate. Sensitive sectors get squeezed by the rate story. Some utilities may look safe, but can struggle with inflation and regulation, debt. Heavy growth stories become more fragile. Meanwhile, energy infrastructure, certain defense names, and companies with real pricing power begin to stand apart. That is the right map. Not because every company in those buckets behaves identically. Because the pressure is now differentiated. This is where shallow investing fails. The shallow investor asks, market up or down? The structural investor asks, which businesses can reprice? Which businesses collect tolls? Which businesses depend on cheap debt? Which businesses pay fuel rather than collect it? And which businesses are about to be sold harder than the actual damage justifies? That is a much better question. Pipelines, storage operators, and service layers inside energy matter because they collect on movement rather than only on heroic commodity speculation. The toll collector often lives better than the driller in a chaotic world. That is not always true. It is true often enough. Companies with real pricing power matter because when costs rise, they can pass them through without destroying demand. That is beautiful in an inflationary squeeze. Healthcare can have that. Certain large technology businesses can have that. Essential services can have that. By contrast, airlines are almost a parody of fragile economics in a fuel shock. The source material is especially blunt about airlines and generally warns against broad consumer, rate-sensitive weakness while favoring energy infrastructure and pricing power. Good, because fuel-heavy margin, thin businesses do not need a full recession to suffer. They only need enough cost pressure to make the existing model ugly. That is the equity repricing chain. And if you understand it correctly, a crash stops looking like one giant, undifferentiated catastrophe. It becomes an auction of which business models can still survive the new price of energy and capital, and which were secretly built for a cheaper world. That is where wealth gets sorted. Now let me take you into the seventh mechanism. I call it the oversold window. This is where opportunity begins showing up for people with enough nerve, enough cash, and enough discipline not to confuse volatility with clarity. The oversold window is what happens after the first violent liquidation, when sentiment is broken, prices are stretched, and the market starts nearing the point where the second fear overtakes the first. That is the window. The first fear is inflation and energy shock. The second fear is growth damage and policy response. And once the second fear becomes louder than the first, the market begins front, running whatever relief it thinks will eventually come. That is why the biggest money is rarely made by buying the obvious first-order war winners after they have already run. It is made by buying the assets that were liquidated too far, yet still have real structural life once the policy machine turns, or the market simply realizes the sell-off went beyond reason. The source material hints at this when it warns that everything sells panic gives way to a later phase where money flows to true winners, and it also points to some beaten-up pricing, power names, and other sectors that may become attractive if sold too far. Exactly, that is the oversold window, and it is always emotionally miserable. That is why it pays. The public wants clean certainty. The market pays for disciplined classification and dirty conditions. That is a different skill. You are not supposed to feel comfortable there. You are supposed to have a plan, enough cash, no reckless leverage, a map of what is structurally damaged and what is temporarily repriced, a willingness to begin building into quality while headlines still feel rude. That is the edge. Now let me be very clear. Oversold does not mean safe tomorrow. It means the conditions for violent reversal are being prepared. That is different. And if you are levered, you may still be destroyed before the turn. The source material is explicit that leveraged products can wreck retail holders on the way down, especially in metals. Correct. Leverage and oversold are a vicious combination. That is why the right way to use an oversold window is not heroics. It is structure. A person with cash in a list is in a different emotional universe from a person with margin and hope. That is the difference between using a crisis and being used by it. Now let me take you into the eighth mechanism. I call it the wealth split. This is where the whole file finally becomes honest. Not everyone will get rich from this. Some people will freeze. Some will chase oil too late. Some will dump gold at the low because the flush made them forget the longer game. Some will hide in the wrong safe sector at the wrong valuation. Some will cling to high. Multiple stories built for a cheaper rate world. Some will use leverage because they mistake volatility for easy opportunity. Some will wait for perfect clarity until the price of clarity is much higher. That is the split. The people who come out stronger are not necessarily the smartest in any academic sense. They are the ones who understand sequence. They understand that a choke point can tax the world before it closes. They understand that oil can become a ladder into inflation, then into a Fed prison, then into a stronger short-term dollar, then into a gold flush, then into a much uglier repricing of fragile equities, and finally into an oversold window for the businesses and assets with real durability. That is sequence. And sequence is how the world redistributes wealth. Not because justice arrived, because structure arrived. Now, let me make the identity flip explicit. Most investors think their job in a crisis is to react correctly to the headline. That is too small. The real job is to map the chain reaction before the public stops arguing about the first link. That is the flip. A headline watcher asks, "What happened today?" A steward of capital asks, "What does this force next?" And which claims become stronger or weaker because of it. A headline watcher sees oil, a steward sees inflation rates, the dollar, gold margins, financing, and forced selling all tied together. A headline watcher wants to sound informed, a steward wants to be positioned. Those are different people. The market pays them very differently. Now, let me bring the operating system together in plain language. First, do not wait for a full closure or final military outcome before treating the choke point seriously. The market will move first. Second, think of oil as a chain reaction, not a commodity quote. Third, read a stronger dollar in this phase as a short-term pressure signal, not as proof the system is healthy. Fourth, treat gold's decline during forced liquidation periods as positioning data before you treat it as thesis failure. Fifth, classify businesses by fuel sensitivity, financing sensitivity, and pricing power. Sixth, avoid leverage if you want to survive the oversold window long enough to use it. Seventh, Prepare a list of the assets with real structural life before the crowd finishes panicking. That is the operating system, not gambling, not passivity structure. Now let me put the blade into this as cleanly as I can. $200 oil is not dangerous because it sounds dramatic on television. It is dangerous because it can turn one geopolitical shock into a single integrated machine that pressures inflation, traps the Fed, strengthens the dollar, flushes gold, crushes fragile equities, and then creates a transfer window for anyone disciplined enough to understand the sequence before the public does. That is the real story. And if you remember nothing else from what I said, remember this. The biggest mistake you can make is thinking the market owes you one clean reaction to one ugly event. It never does. It gives you phases. And the people who build wealth in phases are the people who stop trying to be emotionally right about the headline and start being strategically early about the chain.